Welcome to Investors Guide. Thank you so much for tuning in. It's a brand new week and we're going to try and answer as many of your questions as we can through the course of this show. On the show this week, we'll help an investor save enough to start a company of his own. In our product review, we look at the quantum long-term equity. We'll try and figure out if that lower cost is actually translating into higher returns. And we'll tell you how to save on tax by investing in mutual funds. Let me first bring in Dhirendra Kumar, the CEO of Value Research and our expert on mutual funds. Dhirendra, thank you so much for joining us. Our portfolio question is very interesting because 38-year-old Rajesh K has written in from the Philippines. Now, he's been watching our show on a regular basis and he's looking to build a corpus of 35 to 40 lakh rupees in the next 2 years for his startup. So he sent us his entire financial details and it's very comprehensive. It's a massive list of things that he has. So we are going to have to spend some time on it. And the reason why we've picked this particular question is because there are a lot of things in this case that will apply to the viewers who are watching at home as well. Now, he has 20 lakh rupees put aside for his children's education in a fixed deposit and 15 lakh rupees in his wife's name for, he says, monthly expenses for the next 15 years. And these are in fixed deposits. And he's going to, generate a, a return from it that will be used for his children's education and his wife's monthly expenses while he's starting his company. He also has 2 accounts for PPF in his wife and his daughter's name for 1.2 lakh rupees. 10 lakh rupees in tax-free bonds. He's thinking of buying another one for his daughter as well. And he's generating some rent on a home that he owns. He has 2 residential plots, a commercial plot in Jaipur, and he also owns a house that he's given out on rent for 9,000 rupees. He has LIC plans and he's looking to surrender them over the next couple of years, a family floater plan as well. And he's looking to buy a critical illness. Now, before we get to his mutual funds, if we just look at his portfolio so far, it's tilted completely towards fixed income. And if we consider the fact that he's looking to generate monthly, returns over the next 15 years, which is fair, is there a more efficient way to do this than to use a fixed deposit?
No, it is not unusual. Of course, it is not the finest way of doing it. But it's not unusual for conservative investors to be doing nothing but putting, and it is good to actually have that money in fixed deposit than not having it. But it's definitely, the inefficiency comes there from the fact that, in India, if this money is lying in rupee-denominated deposits, then it is not beating inflation. Your money is effectively would have gone down in value, despite you seemingly earning 9% or 8.5%. Or even up to sometimes 10%, but your real inflation, every individual's inflation number is different from the one which government releases. So from that standpoint, the whole focus of any long-term investment should be that it beats inflation. The least that you should expect is that the value of money is protected, and then comes optimizing return on that. And from that standpoint, it is a very inefficient allocation, more so from the point that, the money for child's education. And the kids are very young, 7-year and 5-year-old. So you still have a lot of time on your side. So that is a kind of, a part of that money should definitely be finding its way into equity. That 10 lakh rupee or 20 lakh rupee in a deposit for child's education, which is still 10, 12, 15 years away, might be, a huge opportunity loss. Then comes, doing some real groundwork in terms of what is going to be the likely monthly household expense, and be conservative. Think in terms of having 3-year, 5-year expenses in hand, or even a capital which will produce income in a conservative way, which can take care of your household expenses. The rest of the money for all your long-term goals, which are 10 years and more, away 10 years and more, should be finding its way, maybe conservatively in a balanced fund, maybe not in all equity, but in a very concerted way should find its way into equity.
Dhirendra, I want a quick review from you on the tax-free bonds that he's holding, 10 lakh rupees in his wife's name, and he's thinking of putting a similar amount of money in his daughter's name as well. Is that something you'd recommend? Now, as NRIs, obviously, he gets a preferential rate on the deposit that he might use if he's using an NRE deposit. But the tax-free bond, is that something you'd recommend?
Tax-free bond is very useful for people who are in the highest tax bracket. And they are looking at, they're expecting a guaranteed return. So effectively, these tax-free return, the one which is on offer right now from NTPC will be yielding little over 7%. And 7% tax-free is good for somebody who has no appetite for any risk and is going to depend on that income. And but that is only in case of people who are in the highest tax bracket, because it effectively means 10% guaranteed return or little over 10% taxable return, which translates into 7% tax-free. But for most other people, if you are not looking at generating income or having a reliable income, but you have a long-term investment time frame and you want to optimize your return on investment, this is not a great way of saving. It's meant for conservative investors looking at secured income.
All right, so Rajesh, this is what we're saying to you right now. While we're very happy that you've actually set aside all of this money before you start your business to make sure that your wife and child are looked after, it does seem like you've picked extremely, conservative investments at this point, and the longer you keep them invested, it seems like you want to hold those for the next 15 years. Your money will keep going down in value. Then let's take a look at his mutual funds. He has Franklin India High Growth, HDFC Mid Cap, HDFC Top 200, iPru Blue Chip, iPru Value Discovery, SBI Emerging Businesses, Tata Ethical, UTI Opportunities, and UTI MNC. Now, going by the aims that he has and the goals that he has right now, it does seem like it could use a little bit of streamlining. If you look at his portfolio, would you like to make a few changes to his portfolio at this point?
Actually, he has chosen very high performance fund, and high performance fund, and most of the funds are fairly diverse funds. So I really don't have much of a suggestion except for the MNC fund and the ethical fund, which might turn out to be a little narrow in their focus allocation. And for somebody who wants to be passive with his investment, keep investing for a long period of time, by just dropping these two funds will actually make it more manageable portfolio. And he has chosen great funds.
All right, you've chosen great funds. Surendra only has one piece of feedback for you, which is drop the two funds, the MNC fund and the ethical fund, and you seem to be okay. Of course, move a little bit of money from all of your conservative investments into these equity funds, and you'll be able to beat inflation over the long term as well. It's time for our product review, and this week we're looking at the Quantum Long-Term Equity Fund, and there's a reason why we're bringing it up. Santosh Palekar wrote in to us on Facebook. He told us that he's invested in the fund, in Quantum Long-Term Equity, and he's worried about the recent performance. He wants to know if he should continue investing in the fund, or is it time to pull his money out. In fact, Avan pulled up the latest numbers so we can get a comparison of how this fund has performed vis-a-vis the benchmark and its peers. Avan, take us through those numbers.
Thanks, Faye. The fund in focus this week is the Quantum Long-Term Equity Fund. Now, although the fund is not the oldest in its category, it's not a new name for our investors watching the show. Interestingly, this fund also has the lowest charges amongst all equity funds. But do lower charges translate into higher returns? Now, the fund was a stellar performer during the first 5 years after its launch, with a 5-star rating for much of its tenure. But in the recent times, the performance has been disappointing. Let's take a closer look at the performance chart over the last 5 years. The red line is the fund and the blue line is the benchmark, the BSE Trisensex. Now, you'll see that the fund has been well above its category and its benchmark up until 2012. In fact, the fund's performance was good even during the bear market phase of the market. But you'll also notice that the performance fell below its category in the year 2013. The fund, which has been heavily investing in debt, has been a concern ever since, thereby lagging behind its peers and slipping in its rating down to 3 stars. However, the fund has outperformed its category and its benchmark when it comes to the long term. But is that reason enough for you to hold on to this fund, or is it time for a sell call? Let's find out. With that, it's back to you.
All right, Avan, thank you for that update. Surendra, if we look at Quantum Long-Term Equity, you recommended this fund when simply because it had a much lower cost ratio, expense ratio. So it's at 1.25, but a lot of other equity funds tend to be higher than 2.5%. So that's half that. It's lower by half. But if we look at the performance over the last 1 year, it hasn't been that great, especially if we compare it to its peers. It's actually lagged quite a bit. So the lower expense ratio is not really translating into higher returns. Would you say it's time to sort of give up on this philosophy altogether, or does it make sense to hold on and watch this fund for longer?
Undoubtedly, this fund has been a struggle. It has not been able to beat its, 2013 was an outstanding year for the fund. 2014 was a good year, but it was at the bottom of the pack, somewhere in the bottom of the pack relative to its peers, and so is now. Likewise, the other thing which has now been demonstrated by the fund, that this fund often takes a cash call. It is sometimes heavily, a good part of its portfolio is not invested, and it's run very conservatively. So that, to my understanding, is not the deal. That is something which has been extremely disappointing with this fund. But I still wonder that there are great funds which have who have a bad patch. Their calls don't go right. Right now we are witnessing that the largest largest equity funds in India have similar kind of struggle. The fund is scared of to get into the relatively expensive part of the market, and that is where the most of the performance has been derived by most other successful funds in recent times. Likewise for this fund has also been very conservative with its, it has been very value oriented. It has not been into the relatively expensive part of the market, and that is why it has struggled. But as I keep saying that markets are cyclical, it will have its day, and this should not be the only fund which one should have.
All right, so this shouldn't be your core holding or your only holding. Dhirendra, if we look at the returns over the last 1 year, 14% vis-a-vis, other funds that might have done better. If you were to give it a star rating for this show, where would you place it?
Undoubtedly, this fund has been a fairly average fund. At the same time, I don't find too many questionable things. Cost remains an advantage. Relatively, and I certainly dislike the fund's, tactical way of looking at its allocation. It is not. It was, 25% into cash not very long ago. So that is something which, of course, the fund manager has taken a call on that, and it says that it will keep taking such a call. But these are two, things which, one what I like, one which I dislike, and its strategy might work at some point. So I would say that it has been an average fund of late, and I will assign it a 3-star.
3 stars for the Quantum Long-Term Equity Fund. Dhirendra, for viewers like Santosh who've written in saying, I'm a little worried about this fund, I don't know whether I should hold on to it, what would you recommend? Hold on to it for a little while longer?
Yes, undoubtedly. I think, we are coming to a point where the hypothesis of this fund might come true, where it is what it is emphasizing in its portfolio might turn out to be, and we find through this whole rejigging of the market's preference in recent weeks that this fund and funds with similar strategy, other equity funds with similar strategy, are a beneficiary of that.
All right. There's the rating on your screen right now. That's the Quantum Long-Term Equity. If you have a question about a fund that you're holding, feel free to write to us. Our email ID is at the bottom of your screen. Karthik has written in from Tamil Nadu, Dhirendra, as part of our hold or sell segment. Well, Franklin India Prima Plus is the first on his list, Dhirendra. Along with Franklin India smaller companies, there might be an overlap there between those two funds. He also has the Feeder US Opportunities, which is a US based fund, is one of the top performers, so that's an obvious choice. If you were to choose between the other two, Prima Plus and smaller companies, should he continue with both of those?
Franklin Prima Plus is a large and mid-cap fund, a fund which invests across the universe, and smaller companies being a larger small-cap fund, smaller companies fund, it is relatively into larger, also because of the quality focus at Franklin Templeton. It is relatively in the larger, small-sized companies, so to say. So there might be an overlap, but if a small part of his money going into smaller companies fund, I don't think there's much to worry.
All right, nothing to worry about with those three funds. Quantum Long-Term Equity, we just talked about, Dhirendra, along with Mirae India Asset Opportunities. Continue with both of these as well?
Yes. In fact, in a portfolio like this, where you have 4 funds and one of it turns out to be Quantum Long-Term Equity, I think such investors should not worry about it. On a full market cycle, I'm still very hopeful that these funds, which are completely out of favor in recent year and a half, they will be a big, they will add significant value to one's portfolio.
He also has the Parag Parikh Long-Term Value Fund, Dhirendra. This is such an interesting fund. Given everything that's happened over the last 1 year, would you recommend he continues this investment?
Parag Parikh's long-term value fund is a very impressive fund, though not very old, but it reflects a very clear thinking. So it gets you a great diversification. It is an all-in-one fund. It's a very conservatively run fund, not necessarily a pure value fund, because many a times it is, it's very thoughtfully managed. A very carefully chosen set of stocks, and a long-term orientation, which is very much visible here. Not too many changes since the start of this fund. So yes, this is an impressive fund worth having.
All right, it's an impressive fund worth having. Dhirendra, I'm going to take the last couple of funds together because I know these are regulars on the show. The ICICI Prudential Value Discovery, HDFC Midcap Opportunities and IDFC Premier Equity Plan. Continue with all of these ones because they're in line with your recommendations.
Yes, they are very much in line with our recommendation. And of course, be watchful of the IDFC Premier Equity Fund, where there has been a change, but the portfolio continues, and I think the legacy should be continued. And if somebody is working on in the given framework which was set out for this fund, if that continues, but it is still a big change worth keeping track of.
All right, so there you have it. On your screen are Dhirendra's recommendations. If you'd like us to take a look at your portfolio, write to us. Our email ID is on your screen. Dhirendra, thank you so much for spending time with us this week.
Thank you.
So we brought in Vishal Kapoor this week from Standard Chartered. Vishal, thank you so much for joining us on the show. It's always a treat to have you on Investor's Guide. Vishal, our first question comes in from Suresh. He writes to us saying that he has a substantial portion of his investments going into fixed deposits, which are not tax efficient. He wants to move this money maybe into liquid or money market funds, and he wants you to help him invest 1.5 lakh rupees somehow in ELSS as well to save tax. What is the best way to do it? So obviously, for someone investing in fixed deposits, he's going to find it slightly jarring to move entirely into equity. So he might have to do it in a phased manner. What's the most efficient way to reduce tax for an investor like this one?
Mr. Narayanan, you've asked us about our options or choices for the ELSS category of mutual funds. Our current recommendation is to look at the Birla Sun Life Tax Relief 96 as well as the Franklin Tax Shield. Both these funds have got a very good long-term track record as well as a good outlook. So these would be our two choices. Now, depending on the amount you have available for investment, may be a good idea to split it up between these two because you're getting two different styles, you're diversifying across two fund management houses. Mr. Narayanan, on the second part of your query about a fixed deposit or a money market or a fixed income mutual fund, I think it's a choice of how long you want to keep that money invested. For the first 3 years, the taxation is very similar. But after 3 years, the fixed income mutual fund does become quite attractive in terms of taxation. So I think the returns obviously could vary depending on how interest rates go. Now, fixed deposit will give you far more stability, but the fixed income mutual fund may give you some amount of capital appreciation as well if you expect interest rates to come off. But from a taxation standpoint, more than 3 years, I think a fixed income option is much better.
All right, we hope you wrote that down. 38-year-old Rahul Sharma has written in from Kanpur. He's been investing 7,000 rupees a month in mutual funds. Now, he sent us a list of his mutual funds. These are meant to be held for the next 10 to 12 years. He has the iPru Value Discovery, Reliance Equity Opportunities, Franklin India Smaller Companies, L&T India Value. And he now has another 5,000 rupees to invest. So he wants to know if he should be putting this money in an RD or in a debt mutual fund. He might need, some sort of debt exposure, Vishal. What would you recommend for him?
A recurring deposit would be better over the shorter tenor of period because it would give you more specific, more consistent returns. But from a taxation standpoint, both products are similar up to 3 years. But since your investment time horizon is more than 3 years, a fixed income fund option becomes better for you. And in that space, I think we would want you to prefer a very high quality bond fund, which is not taking too much credit risk in the current environment. So our pick for you would be the Tata short term bond fund, or you could look at the BlackRock short term bond fund as well. If you are okay with a bit more volatility, with which a bit of duration play would bring in the bond portfolio, you could also look at the IDFC SSIF investment plan. So these could be the three plans, the last one being if you're okay with a bit of volatility, chasing a bit more returns.
All right, last question on the show comes in from Avdut, who's written in. He's been investing in the SBI Blue Chip and Axis Long-Term Equity Fund, both great funds. He wants to now invest in perhaps UTI MNC, the JP Morgan Mid and Small Cap Fund, and he wants to know which of the two you recommend. Vishal, if looking at the two funds that he's holding right now, he obviously needs something to give him sharper returns. What would you recommend of the two choices?
Mr. Avdut, you've asked us about investing in the JP Morgan Small and Mid Cap Fund as well as the UTI MNC Fund. So first let me take the mid cap space. Now in that space the JP Morgan Fund is a good fund. It's been reasonable over a medium term, but in that space we specifically like the UTI Mid Cap Fund better. We think that at least off late it has had a better performance than the JP Morgan Fund. And it's a good flagship fund. It's got reasonable asset size as well now, so that could be an option for you. Having said that, JP Morgan is also a good quality fund, but our preference would be the UTI one. The second one around the MNC space. UTI MNC is a good fund, but you must recognize that you are getting into a sectoral fund now. So if you're sure that MNCs as a theme is your call, then that's a good fund to be in. But you will have to track that more closely along with the ebbs and flows of how the MNC sector, as a theme is performing. So these could be both good choices in your portfolio.
If you have a question for Vishal Kapoor, and he's been helping us now with our investments for nearly 7 years, feel free to write to us. Our email ID is at the bottom of your screen, and we'll ask Vishal to answer your questions for you. Thanks so much for watching Investors Guide this week. Remember, we're here to help, so you can reach us on Facebook, on email, and you can reach me on Twitter. Thank you so much for watching.